Heartily welcome to all of you on our YouTube channel, CS Sansaar. I'm speaking Stella from CS Sansaar. Today we are back with an interesting topic. The topic is the small and medium enterprises, the entire public offering top 10 mistake to avoid. For that, we're having the CA Rakesh Kumar Singh sir. First of all, thank you so much, sir, to joining us and also giving your valuable time. So, sir will be explain us the top 10 mistake to avoid and guide us in right way. So, before we further ado, I having a smallest request to all of you those who are watching us to subscribe our YouTube channel and do not forget to like, share, and comment. Now, sir, I would like to invite you to share the thoughts on the today topic and please explain.
Okay. Good afternoon, everyone, and thank you, Stella. I would like to sincerely thank CA Sansar for creating such a wonderful knowledge sharing platform for finance and business professionals. CA Sansar has consistently played an important role in consulting experts, professionals, and learners through insightful discussion and relevant and emerging topics. I am truly grateful to CA Sansar for giving me this opportunity to share my thoughts on every important and on this important and contemporary subject. A special appreciation to Estella for conducting this session with such professionalism, clarity, and engaging styles. So today's topic is SME IPO. And what are before going for SMEs IPOs? What are the 10 mistakes the SMEs needs to avoid? Because those mistakes becomes a crucial factor in non-successful of any IPO of the SMEs. So today we are going to discuss a very relevant topic in the Indian capital market ecosystems. SME IPO and the most common mistakes companies make while preparing for them. Over the last decade, SME IPO have become a powerful growth engine for small and medium enterprises, enabling them to raise capital, improve governance, and gain market credibility. But while the opportunity is huge, the journey to the successful IPO is complex. But and many companies make avoidable mistakes that can delay or even derail their listings. In today's discussion, we will look at the 10 most common mistakes SMEs IPOs do and how to avoid it. Before we dive into the mistakes, let's first understand the ecosystem. In India, SME IPO are governed primarily by the Security and Exchange Board of India, SEBI. Under the SEBI ICDR regulations, SMEs can list on two dedicated platforms. One is BSC SME platform, and the other is NSC Emerge platforms. These platforms were created to allow smaller companies to access public capital market with relatively simpler compliance requirements compared to main board IPOs. To qualify for SMEs IPO listing, companies typically need post-issue paid up capital up to 25 crores, track record of operation, positive net worth, and strong corporate governance structures. So moving to the entire PPT, let me move to the next slide. So the first mistakes which a SME do before going for the IPO. Poor financial record keeping. Poor financial record keeping. So the first of all, any organization who has taken a target to go for SMEs IPOs, they need to ensure that all their books, either in the form of profit and loss account, either in the form of balance sheets, they needs to be properly adhered as per the Indian Companies Act. As per the Indian Companies Acts, they need to ensure the complete CFO of the organization, the management of the organization, the auditor of the organization need to ensure the record keeping of the companies are in proper form so that there is no complexity when there is audit being done at a later stage when they are going for new IPOs. So this is the first mistakes they need to avoid. They need to have a healthy record keeping so that the investors or the stakeholders who are directly or indirectly related to the organizations, they are very much confident on the trust and transparency of the entire transactions which is already included in the books of account of of that organizations. So moving ahead, the next is ignoring regulatory compliance. Ignoring regulatory compliance. Another major issue is ignoring regulatory compliance. Many promoters focus only on growth and overlook compliance requirements like GST filing, tax compliance, labor laws, environmental regulations, SEBI disclosure norms. Failure to comply can lead to penalties, regulatory scrutiny, and even rejections of IPO proposals. The solution to build a strong compliance framework early with professional advisors. So, if you do not have the manpower resources who are not aware of the compliances, you need to take consultancy from the experts so that all these compliances are regularly added, and that will make and help the organizations in having a successful IPOs. Moving ahead, the implausible valuation expectations. The implausible valuation expectation. The third mistake is unrealistic valuation expectation by the promoters or the company's management. Promoters often expect premium valuations without sufficient financial justifications. But capital markets are driven by comparable financial performance and investor perceptions. Overpricing is issue. The issue can lead to poor subscription, weak listing performance, and loss of credibility. The right approach to rely on independent valuation expert and peer benchmarking. So whenever you plan for an IPO, the entire stakeholders, the management team, the promoters, they need to sit together. They need to brainstorm on what basis they are expecting the valuation. They need to compare the market, they need to compare the competitors, and they also need to take the case studies of a similar companies which has already done the IPO. Then only they can do a proper valuations. The poor corporate governance designs. Moving ahead, the poor corporate governance design. This is again a very important factor. Corporate governance is critical in public markets. Many SME operate under family-centric management structure, which may work in private businesses but raise concerns for public investors. Institutional investors expect independent directors, professionalism. Whenever you are going for a public, just be ensured that there is a third eye which is always there on your books of account or the entire transactions which a company do, and that you need to satisfy the requirement of that third eye. Either that third eye will be either the investor will be there, the indirect or direct stakeholders will be there, the employees will be there, and whosoever who is interested in the organization, as well as the government, the regulators are there who is regularly scrutiny at each and every steps of the organizations. So companies that build governance structure early tend to gain higher investor trust and better valuations. So this factor is also very much important. Moving ahead, sorry, mistake 5. Inadequate time and resource. Some promoter try to complete the process within 6 to 9 months, which is often unrealistic. In reality, preparing for an IPO requires 12 to 24 months of planning, including financial restructuring, compliance, alignment, governance, implementations, documentation, and due diligence. Starting early significantly reduce regulators, delays, and operational stress. So you need to ensure that you need to not be in hurry. You need to follow each and every steps. Your teams are ready. The compliances are properly fulfilled. Similarly, all the data, all the analytical data, all the valuations which you expect are done in a rightful manner, then only you need to move ahead. Don't be in hurry, or else you will be failure in the IPO, or your expectation valuation expectation is not going to meet. So have patience, do all the complete due diligence, then only move ahead. Poor financial management control. Another major mistakes is the absence of a strong financial control, is the absence of a small financial controls. Companies move to public markets must demonstrate internal control systems. Internal control systems, I mean to say that there should be a process, there should be a professionalism, there should be a proper step by step records for whatever transactions you need to do, so that you are not dependent on the manpower, but you are dependent completely on the process. And a process driven companies are always healthier. Transparent account process and periodic audits, there should be a periodic audit. Also, whatever there is the records which are maintained in the books of account, you need to have the supporting documents for each and every transactions of your books of account, so that whenever an audit comes, there should not be any hidden transparency. There should be a proper transparency for each and every record keeping. Without proper financial management systems, companies may face audit compliances, financial restatement, and investor skepticism. Therefore, SMEs must strengthen financial governance well before the IPO process. Moving ahead, unrealistic growth projection. Unrealistic growth projection. We have already read earlier with regard to the valuations. Some companies present, yeah. So there should not be unrealistic growth projection. Some companies present overly optimistic projections to attract investors. Whatever projections you give to the investor, me ensure that there should be a proper backup. There should be a logic behind that, and there should be complete transactions and incomplete adherence to all the stakeholders of the company, so that the projections can be achieved in a very easy way. However, unrealistic projections can backfire as well. If post-listing performance fails to match expectations, the share price can decline sharply, damaging market reputations. The best strategy is simple: under promise and over deliver. Don't give over projections. Rather than going for over projections, try to be conservative. Investor prefer credible and achievable projections supported by market data. Moving ahead, failing to build leadership team. This is a very important factor for any of the SMEs companies who are planning for a future IPO. Investor invest not only in business, the investment management team. Many SMEs depends heavily on the founder and lack professional leaderships in areas such as finance, operations, and strategy. Building a strong team including experienced CFOs, CEOs, chief operating officers, and independent board members significantly increase investors' confidence. So there should be a proper professional and a specialized manpower, so that they can manage the company the way it is required by the investors. Next is weak investor communication. This is again a very important factor which needs to be captured while we are targeting for future SMEs IPOs. Investor communication plays a critical role during the IPO. Companies must clearly articulate the business model, the competitive advantage, and the growth strategy, as well as use of IPO proceeds. So whatever inflow you are expecting from the IPO, and how you are going to use it, that needs to be properly captured. Weak storytelling or poor presentation during road shows often result in low subscription levels. A strong investor narrative is therefore essential. lack of professional advisory support. The final mistake is avoiding professional advisory support to save cost. An IPO requires the expert of multiple professionals, including merchant bankers, legal advisors, auditors, compliance consultant. Trying to manage the process internally can lead to documentation errors, regulatory delays, valuation mistakes. So what I want to say that you need to take advice from the expert, the professionals who have already experience in this particular field, so that there is no chances of an error while you are targeting for SMEs IPO or you are targeting for an IPO of your organizations. Engaging experienced advisory early ensures a smoother and more successful IPO journey. Since we lack times, so don't take risk, but keep on moving and try to take the advices of the experts so that you don't have any embarrassing situations at the end. The final slides. To conclude, SME IPO represent a transformational opportunity for growth business. They enable companies to raise growth capital, enhance brand credibility, improve governance, and unlock shareholder value. However, success in public markets requires careful preparations, transparencies, and professional guidance. Companies that avoid these common mistakes and adopt strong governance practices can successfully transition from private enterprise to public listed growth stories. Thank you for listening, and thank you, Stella. Thank you, CS Ansar.
Thank you so much, sir. Very wonderfully explained the step by step, the top 10 mistake to avoid, which we have to do. And hope those who are watching they understood very well. And if you guys having any doubt, please drop your comment, and definitely we will reply you and review your questions. So again, thank you so much, sir, for joining us and also giving the wonderful explanation.
Thank you, Stella. Thank you, CS Ansar.